If you're serious about purchasing a home and not paying cash, the first thing you need to do is get pre-approved for a mortgage. A lot of buyers think it's a good idea to look at homes, find one they love, and then get pre-approved. However, this puts you at a major disadvantage to those who have already been pre-approved. So let's talk about what it means to be pre-approved and the importance of it. So what's a pre-approval? Well, a pre-approval is getting qualified for a mortgage before you find a property. Now, you might have heard of a pre-qualification, but that's actually different than a pre-approval. So let me explain the differences. A pre-qualification typically involves you having a conversation with a mortgage lender or a bank or a broker, discussing what your plans are with the home buying process, telling them what you do for a living and how much money you make and how much money you have saved, and possibly having a credit pull, and that lender providing you with a letter for an amount you're qualified for based on the information you told them. Now, what makes that different than a pre-approval is you would have that same conversation with the lender when getting pre-approved. However, you would actually provide documentation to support the information that you told them. So which one of those two things do you think holds more weight, is going to be more accurate? Well, I would say the pre-approval, because although you're not lying, or I imagine you're not lying to the person you're speaking with and giving the information to, sometimes you may not know what a lender is actually looking at when it comes to qualifying you for a mortgage. You might be self-employed, for example, and your business brings in $200,000 in gross sales. And you might have told the lender, I make $200,000 a year. But when you get your tax return over to that lender, it might show that you personally made $50,000 from the business. Although the business brought in $200,000, the business might have had $150,000 in expenses, leaving $50,000 that you made. So during the pre-approval process, that's something the lender would have seen, and it would have affected the amount you actually qualify for. That's why it's so important to get pre-approved rather than getting pre-qualified. Now, once you get pre-approved, the lender actually gets you the true pre-approval based on the information you provided. The benefit to you is that when you go out and start looking at homes, it's going to show the realtors and the sellers of the property that you're interested in that you're a serious buyer, because you've already taken the steps necessary to qualify for that home. It's going to set you up for success and not failure. And the reason I say it sets you up for success is because once you find the right home to submit an offer on, if you're pre-approved, there's nothing holding you back from submitting that offer on the property pretty much right then and there. If you wait to get pre-approved after you find a property, I say you're setting yourself up for a failure, because now time is not on your side, especially if it's a multiple offer situation, which in most markets, if it's a high demand home, there's going to be more than one offer on that home. So you not being pre-approved prior to looking at the home is setting yourself up for failure, because most homes that you're going to see, I would imagine, are going to be on the weekend. Maybe you work during the week, so you're going to go out on the weekend with your agent. You're going to look for homes. You're going to find a home. And then guess what? If you're not pre-approved, now you're going to have to try to track your lender down. And most lenders, I won't say all, I know my team works on the weekends, but most lenders, or if you're working with a bank or credit union, are not going to be available to you on the weekend to get you pre-approved. So now you're at a disadvantage, and you're not going to be able to submit an offer on a property because no listing agent that knows what they're doing and no seller is going to accept an offer for someone who needs financing without a pre-approval letter. So it's extremely important that you are pre-approved in advance. Now, what does getting pre-approved actually mean? Well, first off, let me give you timing. I always say if you are thinking about buying a home in the next 120 days, so 4 months pretty much, you want to get pre-approved at the front end of that 120 days. And the reason I say 120 days is because your credit report that a lender will need to pull is good for 120 days. And most individuals, including myself, don't want to have their credit pulled multiple times when trying to buy a home. So if you know you're going to buy within 120 days, well, you want to start that process at the beginning of that time frame. And if you are going to speak to multiple lenders, which I certainly recommend you do, you're going to want to do that within the first 45 days of that 120-day window. It's because you're given a 45-day window, your right to shop by the CFPB, to have your credit pulled by more than one mortgage lender specifically for a mortgage mortgage without it negatively impacting your credit score. Now, why is it that you'd want to speak to more than one lender? Well, some might think, well, yeah, because I want to shop around and get the lowest interest rate. And that's not the reason I think you should, because at the end of the day, unless you're going under contract within a day or two of getting qualified, the interest rate's irrelevant because you're not locking a rate when you get pre-approved. You're locking a rate once you go under contract for a home. So the rate that someone quotes you at the time of pre-approval is likely not the rate you're getting once you actually find a property. So deciding what lender to work with based on an interest rate before you found a home doesn't even make sense to me. It's like deciding what gas station you're going to get gas at a week before you need gas. How do you know what gas is going to cost a week later? You don't. So it's the same concept. You can talk to lenders that you've already gotten pre-approved with to see who can offer the best rate once you find a home. But you want to get qualified with those lenders based on what programs and products they offer and how much they can qualify you for. Because believe it or not, one lender may be able to qualify you for more than another lender, not because they're doing anything shady to get you qualified, but it's because some lenders have additional guidelines on top of the set guidelines that are already in place for conventional FHA and VA mortgages. And these additional guidelines a lender may have are called overlays. So if you're working with a lender or speaking to a lender who has extra overlays or extra guidelines, and they might pertain to your debt to income ratio, for example, where they might not go as high as what the guidelines actually allow, they have them maybe 5% lower for that company, you'll qualify for less with that lender than you would with a lender who does not have those overlays. So that's important. Now, when you're getting qualified, it's important to know what a lender is going to be looking at. Now, there are 4 key factors in getting qualified for a mortgage. It's going to be your income, your employment, which technically you don't have to be employed. You might be on a fixed income if you're retired, right? You have pension, maybe you get Social Security, your credit, and your assets. So let's talk about income first, right? So what lenders are going to look at when qualifying you for a mortgage is going to be your gross income, not your net income. So your gross income is your income prior to taxes being deducted. If you're a W-2 borrower, meaning you have a W-2 income, you don't own the business that the W-2 comes from, you're just an employee of the business, it's going to go off your gross wages. Maybe it's hourly, maybe it's a salary. If you're self-employed, it's a little bit different. We're not looking at your gross income to your business, we're looking at your gross income before you personally pay taxes on it. So like I mentioned, when I was comparing a pre-approval to a pre-qualification, if you're self-employed, you're going to get income that's left over after expenses. So your business brought in a certain amount of gross sales, that business had expenses, it leaves you your portion, that is actually your profit, that gets paid to you, and then you take your own tax deductions from that. We use the amount that you profited, right? Because that's almost equivalent to a W-2 being received by an employee of a business. Now, maybe you don't qualify for exactly what you want based on your income alone. Well, that's when we would look at adding a co-borrower or a co-signer. A co-borrower does not necessarily have to live in the home with you. You can have a non-occupying co-borrower, or you can have a co-borrower who will occupy the property with you. A co-signer is someone who is going to be used for income credit and asset qualification, but will not be listed as an owner of the property with you. That's the difference between a co-signer and a co-borrower. Co-signers are typically going to be seen on an FHA mortgage. It's one of the only types of mortgages that allows a co-signer rather than a co-borrower. Now, budgeting, as I've talked about in other videos, is going to be something that you need to do in order to know what your ideal debt to income ratio will be. So if you followed the steps in my top 9 steps that I think you should do prior to going out and looking for a home and working you all the way through your closing, well, one of those things is budgeting. So it's important that you know your budget prior to speaking with a lender, because that lender is going to base things around your budget in order to determine your debt to income ratio. Now, you're also going to look at your credit, as I mentioned, and you're going to look at your credit scores and your debt. Sometimes you might think, oh, just credit score. Well, it's not just about the credit score. The debt that's on your credit is as important. I've talked to people where they'll call me up and they'll say, oh, how much can I qualify for? I have a 760 credit score. Well, that's fantastic. A 760 is a great credit score. It's a top tier, one of the top tiers for a mortgage. But it's not just about the score. It's about what's on the credit report, because those are the things that get factored in to determine your debt to income ratio. And if you're looking at Credit Karma as your source for information of what your credit score is, don't don't do it. The problem is Credit Karma has their own scoring model. Although the information that you're getting from Credit Karma regarding what's on your credit is typically accurate, so you can use it for that, do not use it for the scores. Oftentimes, the credit scores that are pulled for a mortgage are going to be lower than what's shown on Credit Karma, because Credit Karma is really just an informational website. When you're applying for credit, which is what you're doing when you're getting a mortgage, and we're actually pulling your credit and we're getting a FICO score, that score is going to be lower in most cases than what you're seeing on your bank website or Credit Karma or any sort of free credit reporting site. So keep those things in mind. The most accurate scores, if you want to be able to get an idea of what your scores are, is going to be on My FICO. It's an app you can download. I don't benefit from that, but you can actually see your credit scores for any type of debt you're applying for, whether it's a credit card or a car or a mortgage. I will tell you that on that app, the mortgage scores will match whatever the lender is going to pull. And your credit score is extremely important because it can determine multiple things, not just the interest rate. It can determine what the cost of mortgage insurance will be for you if you're required to pay mortgage insurance getting a conventional mortgage with less than 20% down. It can also determine the maximum debt to income ratio you can go to. Some loan programs limit your debt to income ratio based on your credit score, right? So these are things that you need to consider and why your credit score is so important. Every loan program has a different score requirement. If you're trying to get an FHA mortgage or a VA mortgage, you could have as low as a 580 credit score. If you're trying to qualify for a conventional mortgage, you'll need a 620 credit score. And those are things that you want to know up front. So it's important to understand why your credit's important and where the score comes into play. Your debt to income ratio, on the other hand, as I mentioned, right, the debts that are on that credit compared to your income is extremely important as well, because it's going to impact the amount you qualify for. Just like there's different credit score limits or requirements for different loan programs, there are different debt to income ratio limits depending on the type of loan you're getting. So whether it's an FHA mortgage, a VA mortgage, or a conventional mortgage, they all have different debt to income ratio limitations, which is the comparison between your monthly gross income and your expenses, including the new housing expense. Now, something that you might have questions about, and it's a common concern that we hear from younger buyers, are student loans. And, student loans are a big thing, right? Most people that have gone to college are going to have some sort of student loans reporting on their credit. If you're a veteran and you're getting a VA mortgage and you have student loan debt on your credit report that's in deferment or forbearance, and it's for at least 12 more months, and you have no payments, that means we actually don't have to count a payment in your debt to income ratio. If you're getting a conventional mortgage, and we're going to use a Fannie Mae loan, and you have student loans and there's no payments reporting because it's in forbearance or deferment right now, we can use 0.5% of whatever your balances are as your payment. If it's Freddie Mac, it's 1% of your student loan balances as a payment. If it's an FHA mortgage, it's 0.5% of whatever your student loan balances are as a payment that need to get factored into your debt to income ratio. So just to give you an idea, it's different for every loan type. So it's very important to keep that in mind, because having that student loan debt, although you may not have a payment, depending on the type of loan you have, a payment will need to be considered and it will affect the amount you qualify for. Now, let's talk about assets or the cash requirements for buying a home. Now, if you're not getting a VA mortgage, right, if you're a veteran or active duty military, you're going to need money for a down payment. And the amount of money you need for a down payment is going to vary depending on the type of loan. If you're a first-time home buyer getting a conventional mortgage, you can put as low as 3% down. If you're going to get an FHA mortgage, because you're going to buy a property as your primary residence, it does not need to be your first home, you can put 3.5% down. If you've owned a home before and you're going to get a conventional mortgage as your primary residence, you have to put 5% down. So it's important to know the different down payment requirements based on your situation and the type of loan you're obtaining. Now, there are down payment assistance programs available to assist with covering your down payment, right? And we offer some of those, and you can research those online. Check out my video on down payment assistance programs. I give you details on what they are, how they work, and most importantly, where you can find them. But check that video out. There's a lot of good information if you are looking for down payment assistance programs. And then you also want to have money for your closing costs. Your closing costs are your costs outside of your down payment. It's going to be title costs. It's going to be government charges. It's going to be setting up your escrow account. There's multiple costs that go into buying a home outside of the down payment. Once again, if you want to know what those are, please check out my video that breaks down all of the closing costs you should expect to see when buying a home, so that there are no surprises for you. Now, you want to make sure you know these things up front, and you need to be able to source where that money is coming from once you go under contract and have to show your lender that you have the funds available. Sourcing those funds means you need to show that you have them. It can't just be photocopies of $100 bills. The money needs to be in the bank, and if there's any quote unquote large deposits, and depending on the type of loan you're getting, a large deposit is gonna vary. If you're getting a conventional mortgage, a large deposit is considered to be anything that's half of your monthly income or more. If you're getting an FHA mortgage, it's any deposit that's 1% of your loan amount or more, right? So it can vary, but you have to be able to source where that money comes from. If you can't source or show where it came from, it can't be considered for the purchase. Now, your cash to close, right? Your lender's gonna hear, this is your cash to close. Your cash to close is gonna be a combination of your down payment on the property and those closing costs, as I mentioned. So the two combined is gonna be what you need at the time of closing on your property, minus anything you might have paid for in advance, such as an appraisal or any sort of deposit you might have given that was required in your contract, called an earnest money deposit, that's held by title and applied toward your cash to close when the time comes. Acceptable sources of this money are gonna be your own checking or savings. You can pull money from a retirement account if you have. It can come from investment accounts. You can get gift funds if you're lucky enough to have, a close friend or family members who are willing to give you money without expecting you to repay that money, right? Now, what documents are you gonna need when it comes time to get pre-approved? Well, it's simple. If you're a W-2 borrower, you're gonna need your W-2s, you're gonna need your pay stubs, you're gonna need your bank statements, the lender's gonna your credit report, and you're gonna need your driver's license. If you're self-employed, you're gonna need tax returns, typically for 2 years, business and personal if you happen to file separately. Now, if you've owned your business for 5 years or more and you're getting a conventional mortgage, you actually only need 1 year of tax returns to qualify. So the most recent year that's been filed. So you're gonna have to provide your tax returns. If you W-2 yourself from your own business, you'll provide your W-2 from that business. Once again, bank statements, your driver's license. If you own any other properties, you'd have to provide documentation for those properties. Mortgage statement if you have a mortgage, insurance deck pages, property tax bill, HOA, homeowners association, payment coupon if there's an HOA on the property. You're gonna need all of these things. You have to provide them to your lender up front so they can properly pre-approve you to buy a home. So as you can see, there are multiple factors in determining what you can be pre-approved for, so it's important you start the process sooner rather than later. And remember, the pre and pre-approval is referencing before you start shopping for homes. So make sure you prepare yourself accordingly. If you found the information in this video helpful, make sure to subscribe for more videos just like this one. And if you have questions about your personal situation, feel free to leave a comment and I will personally reply to you.